Okay, our next lecture, we're going to look at some of the accounting general ideas, including this slide. It'll be 10 slides. Okay, back from accounting first term. You should be familiar with the accounting equation, assets equals liabilities plus owner's equity. Another way to reframe that sentence or equation is economic resources equals the claims to the claims to those economic resources. And claims, of course, include liabilities, which is maybe a bank loan or a lease or something like that, and the owner's portion of how much of the assets he or she owns. So assets are owned by the bank and or the owners, if you want to put it a different way. Okay, going to run through some quickie definitions here, and I'm a huge fan of short definitions. So my first question, or first definition we're going to look at would be, what is an asset? Okay, what is an asset? Well, simply put, an asset is something we own to make us money. Okay, it's a resource that the company owns. It's got a future benefit in terms of what they are actually, cash, office supplies, merchandise you're going to resell, maybe it's furniture, land, buildings. These are all assets. And we have a couple classes of assets. One are long-term assets. They're going to be with us for more than a year. The company's going to use them. They have them in possession and try and make money from them for more than a year. That's the intent. And others are going to be used up within 12 months or a year to help generate income on a daily basis. Now, just a quick note on assets. When you go to the bank for a bank loan personally, if you want to get a car or even a house or something like that, you'll do a personal net worth statement or an equity statement, whatever they want to call it, depending on the bank. And you will list all of your assets, your personal assets. Okay, these are not business assets. Your personal assets, typically, you don't own them with the idea of making money. You own them with the idea of making your life more comfortable or livable or whatever the case may be. So these aren't really assets in the business sense, okay? You don't own a house usually to make money unless you own a house and rent it out to students, something like that. Same with your car, except maybe if you're going to be using it for Uber or something like that. These are assets that are usually, and I'll say 99% of the time, if we look at the entire population, they own these things without the intention of making money from them. Okay, even if we look at our house, by the time we sell it 10 years from now, it might be worth more money, but in the non-Toronto and a non-Vancouver market, the average house goes up about 2.5% per year. If we add in house insurance, property taxes, and maintenance, usually that's about 6% a year. So if you think of your house's increase in value by the time you go to sell it, yes, it has, but you know what? Over those years, you've spent a lot more on it than the value of the house has actually increased. So that's something to think about. However, if somebody else is paying the rent and paying the mortgage and all that sort of thing, then yeah, that's a great idea. Okay? But generally speaking, these are the type of assets we do not make money from. So on to our next definition. We're looking at liabilities. And the question would be, what are liabilities? And simply put, these are something that the company owes. We owe money for. Okay, we owe it money for a service that's provided or an asset that we want and need for the company. Some cases are kind of vague in that we pay money for services that we don't see for a while, like a retainer. We pay our lawyer up front to do something, and sometimes we pay up front for magazine subscriptions. It just depends on what the case may be in that sort of general speaking. Long-term liabilities, we owe them for more than a year. We won't pay them off for a year. So if we're looking at a long-term loan, 5 to 10 years on a piece of equipment or something like that, that's a long-term loan. And of course, current liabilities are the things that we're going to pay for within 12 months. Now, sometimes we do pay for a piece of that loan within the next 12 months. So we have a current part of a long-term debt. Okay, so just something to think about. Current portion and long-term portion of our debts, quite frequent these days. Okay, when we get to the other part of the accounting equation, we get to owner's equity. Owner's equity is basically what's left over. Okay, we have our assets, we subtract our liabilities, and whatever's left over is our equity. Kind of an abstract idea, and when we go on and say it's the owner's claim or investment in the entity's assets, it's kind of the amount that the company or the investor actually owns of the assets. Okay, so something to think about there. Owners can contribute in two ways. They buy or invest in the entity or the company. They buy shares. And if the company has profits, the owner can take the profits out of the company. We call that dividends. But usually a lot of times they get left in the company. The owner, in a sense, is reinvesting. He's leaving the money in there. So, I mean, we could do an accounting entry where he takes it out, he or she takes it out, and then puts it back in, reinvests it, but same purpose. By owning it in there, you pretty much increase your investment in the company and increase your equity in the company. Okay, so the next question would be, what are revenues? Simply put, revenue is money that comes in the door. Okay, that's, or comes into the bank account, whatever you want to call it. We get that money through running our company. So if we sell some services or we sell some goods, this is revenue. Okay, now if we sell some of our long-term assets, that's a totally different discussion. But for what we're doing here in the class, we're going to just stick with selling our services or selling our products. Okay, so something just to keep straight there. Sometimes you call it sales. You'll see it on an income statement. You see revenue, sales, and there's a couple others I've seen over the years. 90% of the time here in Canada, we see revenue or sales. Okay, so we do our goodies, we perform our services. Now, every once in a while, we're going to see something called rent earned or interest earned. And technically speaking, these are revenues. Now, you say, okay, if I'm a rental company, I'm going to have lots of rent earned. Yes, true. However, if I go out and say I'm going to grow my business, but I don't need all the space I can get right now, I go and find a really good deal for a really good price. I might, if I take the whole space, have excess space. It might be good for me to rent out some of that space to somebody else until I've grown my business big enough to take the whole space. And in that case, it would be called rent earned or rental income. Okay, but I'm not in the business of renting. Similarly, if I have a good chunk of money in the bank that I'm saving up to buy land and buildings, that money may, although in today's market it's not going to generate too much money, but it may generate interest revenue. Okay, and so in that case we would have some interest earned. But again, if we're not a bank, then and we're not in that business, we would expect that would be usually an expense. But every once in a while we will see that sort of thing. Not as much as we used to because of the low interest rates, but it still does happen. Just something to be aware of. I'm not going to cover much of it in this course, but if it does come up, then at least you know what we're talking about. Okay, I think now's a good time to have a look at expenses again. One of the things that we talk about when we talk about expenses is where they come from, all sorts of interesting things like that. But typically speaking, we are talking about assets that we use up to run the business, okay? Or services that we buy to run the business. That's it. It's pretty simple. Where they typically come from two places. Okay, they are amounts that have been paid or will be paid for costs or other things that we need to run the business and earn revenue. Some examples of that, of course, are rent, salaries, utilities, inventory, advertising, insurance, miscellaneous odds and ends. And something we'll look at in further detail next week is something called amortization, which you might have a passing familiarity with, and I'll discuss that as well. Okay, one quick thing that seems to escape some attention or understanding. If your revenues are larger than your expenses, okay, think about that. If the money coming in the door is more than the money going out the door, you're going to have profits. And your equity is going to increase. Okay, your equity is going to increase. So if you're running a company, the best way to improve your equity is to have profits. And equity is also another word for wealth, by the way, so that's something to think about. Now, on the other side of the equation, this particular equation, if revenues are smaller than expenses, you're going to have losses. Okay, and I think you're pretty clear on that. That's a bad thing. And of course, your equity will decrease. It'll go down. Not much to say about that. If you haven't got that straightened out by now, then we probably are in a pretty bad place as far as understanding how business works. Okay, so revenues are less than expenses. You got losses, and you really don't want to be there too long. A lot of companies, you can operate for a year or two at a loss when they start up, but long term, if you have continuing losses, you're not in business very much. Now, just quick note on definitions in general. Every time we start a course, we have a whole pile of definitions we have to go through. It can be a little daunting and disturbing, but let's put it this way. If you don't know the definition for blue, you may be in trouble. If you don't know the definition for green or red, you could be in trouble, especially at a stoplight. These are the sort of things we have to come up with and understand when we go, for instance, to talk to a banker or a potential investor. We have to understand what assets are. We have to understand what liabilities are, and we really need to understand what profits and revenues and expenses are. If we don't know what these things are, and we can't explain them or use them in a conversation, the other person is going to look at you and say, well, I'm not going to invest with you. I'm not going to lend you money. You don't know what you're doing, and you just showed me you don't know what you're doing. This is why when we have courses, and we start out the course with a whole pile of definitions, and we're going to get a whole bunch more as the course goes on, this is why we have to have these conversations. Okay, if I was to say to you, a piece of lined paper with 3 columns, the first column might be the additions to the account, the next column is the deletions from the account, and the third column is the balance of the account. What am I talking about? Well, I'm talking about a ledger. I've used about 50 words to describe one thing, okay? Rather than sit at the table and tell you about this thing that's got lined paper and 3 columns and this, that, and the other thing, I can just say, well, the ledger for that account. That's what I'm talking about, okay? So this is why words are important. It helps us understand each other, and it helps us have much shorter conversations. Okay, so just keep that in mind as we continue, and as you continue with your life.